Let's talk some dividend investing, and in particular, the dividend payout ratio, which is a very, very important aspect to consider before you make an investment into any dividend paying stock, as it's going to offer you a lot of insight and get you thinking about things that are wise to think about. Now, are you going to agree with somebody else's thoughts? Not necessarily, but you don't want to be blind. And that is why investing is fun, because somebody can have an opinion, on the very same thing. You may have a different opinion, but that's what the markets are all about. May the best idea, may the best thoughts win. But let's make sure we are thinking. And again, that's where the payout ratio comes into play. So first, let's talk about what it is. And it's very, very easy. And then where you can find it. And then, like I said, at the end, that'll be more so up to you. And I'll walk you through a couple different other things to consider. But first off, what is the dividend ratio or the payout ratio? And that is a relationship between make and give, meaning how much does the company make and how much do they give out? And that's it. Is companies make money, and then some companies give back some of the money that they make. And that is what a dividend is make and give. So what is this relationship? So the first part is make, right? Companies make money, and for numbers' sake, let's just say that this company makes $1 million. And that other part is, well, how much are they going to give? And yeah, they give it to you. And for numbers' sake, let's just say that it's $300,000. So the relationship, mathematically speaking, is right there. You're going to want to divide that number. You divide the give by the make. Again, you divide the give by the make. So 300,000 divided by 1 million. Now, if you don't want to trust me, that's fine. You can go do the math, but I'll tell you that's 30%, meaning of the money that a company makes, they're giving away 30%. So in other words, they would have a payout ratio of 30%, meaning of the money that we make, we are giving away 30% of it. So that's all that relationship is make and give. And then it's telling you how much of a company that they make are they giving back to shareholders. So where do you find this payout ratio at? Now, there are a lot of sites out there, but this one right here, DI Grin, I'm not sure if that's how you're supposed to say it, but that's what I'm going to call it, DI Grin. And all you do is come over here and let's with Apple. And then you come over here to this area, payout ratio. And what I like about it is it just gives you a very, very big track record. So in other words, Apple, of the money that they are making as a company, they are giving back 13.4%. So in other words, let's just say Apple was making $1 million. That would mean that they're giving back about $140,000 of that $1 million that they've made. So that's the payout ratio for Apple, at least at this moment in time, 14%. Let's take a look at somebody else that's a well-known company. Let's take a look at Coca-Cola. So again, come over here to payout ratio. And right here, they're giving away essentially 72%. And now you might be having some thoughts of, whoa, Apple is so greedy. Like that's all they're giving back? Well, keep in mind, some companies don't give anything back. And look at Coca-Cola. They're giving away 72% back to their shareholders. Wow, Apple is greedy. Coca-Cola is very nice. Those are wrong types of conclusions. And this is where the fun always begins, because you have to start to think about, okay, well, why is Apple giving away so much less? Some people are going to say, well, they're giving away so much less because they want to take some of the money that they've made and then reinvest it so they can come up with new technology, new gadgets. And so they're not going to give it all the way, or they're not going to give it all back to shareholders, because then they don't have any money to research and create new ideas. So that's one angle that somebody could take. Now, I'm not saying that's right. Maybe you completely disagree with that. But again, that goes back to the start. That's why the market's fun, because you can exchange ideas and have disagreements. Where on the other side, Coca-Cola, I mean, it kind of is what it is. They make food, they make beverages. So, I mean, are they out there like innovating stuff? I mean, to an extent, and that's why it's not at 100%. But do they really need to keep most of the money for themselves because they're out there like, no, they're not. They're not known as a growth company. They're known as more of an income company because it kind of is what it is. They're established. They get a bunch of money, so they send the majority of it back to their shareholders. And then let's take a look at AT&T. Whoops, got to click on payout ratio first. So you can see here through their history, but I want to come down to a certain spot right here. Notice these numbers: 136%, 127%. You get the idea. You're wait a minute. These numbers are way above. Now these ones are a little squirrely because there is some manipulation of the share structure, so that's a little misleading there. But the point here being is you have these big numbers over 100%. How is that even possible? They're paying out more than what they actually make. They're giving away more than what they make. Yes. Well, how are they doing that? By taking on debt. So my point here is that, and again, I'm sure some people may disagree, but if you see a payout ratio above 100%, that means that the company is not actually making enough compared to what they're giving out. They are taking on debt to make that dividend payment. And those are situations where, I mean, you can look and like, wow, look at this yield. It's 10%. It's some sort of high percent. But if that payout ratio is really high, again, what does really high defined as? That's where the debate depends. But the higher it is, the more likely that, okay, why is the company giving out so much? Is it because they're not making as much anymore? What exactly is going on? But it has nothing to do with ultimately who's greedy and who's not. It has to do with what are the underlying aspects of the business that you'll, of course, want to figure out more of. And yeah, AT&T, they reached a point, as you saw, where they were making dividend payments, but they were putting themselves deeper and deeper in debt just to make that dividend payment. Now, the reason why it eventually went back is because they cut the dividend. They said, no, we're not going to give you as much as what we once were, known as a dividend cut. But for those people that were watching that payout ratio, they had a sneaky suspicion that, yeah, this number's spinning out of control. At some point, I get it, the yield on AT&T might be really high, but that's about to come down because you got to think that they're going to be cutting that dividend because, I mean, this is not sustainable any longer in terms of taking on debt to make those payments. And then you look at somebody like NVIDIA, and we're now at the other extreme. Look at this payout ratio. So in other words, they're basically giving nothing to shareholders. But again, this is why you would not call NVIDIA an income stock. You would call it a growth stock because the vast majority of the money that they're making, like a lot of other tech stocks, if the tech stock even does pay a dividend. So as of right now, Google does not pay a dividend because they're just reinvesting everything into research. But NVIDIA, I mean, that's nice that they give a little bit of it away. But you would never call them an income stock because, based on those numbers, you see that they're just reinvesting a whole lot of that into new technologies and so on and so forth. So like I said, this is where things, there's all sorts of angles you can approach it. But at the core, low payout ratios are considered safe because, well, I mean, they have plenty of money that they could still ultimately give if they needed to. Whereas if you're at a high payout ratio, there's a little bit more risk of, okay, why is it so high? Is it because the company's now making less? Or is it just because the company, has plenty of money and they don't know what to do with it, so they're just giving out more? Both of those can be true, but that's where you want to get that thought process started in terms of, why is it so high? If it's very low, well, then you don't really have a whole lot to worry about because if you like the yield that they're already paying and it's a low payout ratio, then there's not really any threat that you're not going to get paid that because it's not like they're AT&T where they're paying out way more than what they actually make. But at the core, that's what it's all about. Make versus give. You figure out that ratio by doing the basic division. That's going to give you that percentage. And then you can start to ask those questions about, well, why is it like this? Why wouldn't it be higher? Why is it so high? And you get your brain turning and you can go that's what investment clubs are all about, right? People sitting together and everybody may be looking at the same stock, the same payout ratio, and you might have 3 people doing that and you're going to get 3 different answers. And is that too high? Is it too low? Why is it that way? Is it going to change? Is it going to change for the better or worse? And that's the wonderful, exciting world of investing. But yes, payout ratio, nothing complicated, but a very important thing to consider so that you can at least get the thought process started in the right direction. So if you have any other questions on it or any other questions about dividend stocks, stuff like that, let me know in the comment section. I can always try to do some more videos on it. But hopefully I've done a good job here of describing what the dividend ratio is and why it's important. First off, thanks so much for watching the entire video. Real quick, before you go, I want to invite you to a live webinar, web class, training, workshop, online event, whatever you want to call it, but it will be me live revealing to you what I've discovered that has allowed me to transform myself from being an employee to being my own boss, including how I had only 1 losing day out of 73 days in total. I'm going to cover 3 keys that have helped me unlock profitable consistency within the markets. The first key is super weird, but in a productive type of way. The second key is super awesome because it quite literally is wired into our DNA as humans, making it very easy to use. But in a cruel way, this becomes a pitfall for many traders. I'll explain it all though, including how to avoid the pitfall that it creates for some. And yeah, the third key, when you hear it, sounds way too good to be true, but it's not, and I'll show you how it all works. Then at the end, I open it up for a question and answer session that is, again, totally live. Even if you can't make the live session, please still sign up as it will be recorded, and you can go back and watch the replay that I will send you. Click the image on the screen or click the link down in the description box so you can get the date and time and claim your spot, which I should note is limited due to the fact that this truly is a live event. If you have any questions, let me know. If not, I'll be seeing you soon.